Great. So again, sort of thank you to IFTA. Thank you to Marcus as well for a fascinating presentation. I have to admit, I did mathematics as a degree a long time ago. We're talking about 26, 27 years ago, and it shows you how long it was ago because I had to virtually count on my fingers the number of years when I actually finished university. So a lot of what he talked about, I've also seen through his work. I'm a fan of his work and seen his sort of series of code and read the numbers mystery. So I'd seen his work before, and I find it as fascinating, as illuminating as ever. But what I took away from his talk, amongst a million things, was one, clearly the importance of pattern and ratio through nature. You know, that we see and exist all the time through nature. We see as human beings in our interaction. But we as technical analysts know this very much, in our markets, in our financial jobs. We see these patterns, we see these ratios in the financial markets, which is this melting point of really the total crowd behavior. I was going to say as well, the other fascinating thing was, which I took away from Marcus's talk, was actually how difficult, even as a mathematician, it can be to forecast. There are different times when we can be, one, very confident in our view, we're very confident in our system, we're very confident that we can predict an outcome to an event, but also there are times when we're not. We have a rough idea where we think it may go, we think it may end up, but there are times when we absolutely have no clue. And I think that very much applies to our job as well. There is different states in the market, and as Marcus described, there's a chaotic state, there's a stable state. There is a time when patterns exist and they suddenly change. They turn into new patterns. The patterns completely are abandoned. There are great periods of time in the market where patterns just don't exist at all. And so we as technical analysts see that all the time. And so for myself, having been in the market for 24 years now, essentially doing this job, and 20 years at Credit Suisse, we see that all the time. There's no one set of indicators. There's no one system that we use to overlay on the market. We have to be flexible. We have to be pragmatic. We have to know when to stay disciplined and stick with our view, but we also need to know when to change and when to adapt. And I think that I found very interesting from listening to Marcus's talk and now. And so what we do in Credit Suisse is very much we layer different techniques, we rank different techniques, and then we filter techniques. And what we're trying to do all the time is stack the odds totally in our favor. It really is a numbers game. And actually trying to forecast in ahead is a very difficult thing to do. So what we're trying to do is stack it as much in our favor as we possibly can. And for what we do, I've always found there's almost two different skill sets required. There's the actual entry point into a trade, which can be something quite simple. It can be the completion of a pattern. It can be a signal from a moving average crossover or what it happens to be. But then once the trade is actually owned, it's then a different skill set that's often involved in trading that market. It's position management. And those are two very different things. And it's the balancing of those two things together that I think is absolutely critical. And so, again, I think it's very much a numbers game. And then the one other thing I would say, and this is personally to Marcus, is if you do think it's tough meeting someone at a party and telling them you're a mathematician, just try meeting someone at a party and telling them you're a technical analyst. Because believe you me, that's a lot worse. So, for my talk today, I want to get into, say, declassifying patterns and ratios. I have to admit, I found this quite sort of a challenging sort of, when I was asked by IFTA to talk, sort of subject to come about, because essentially what we're looking at is probably what a lot of you use in your sort of day-to-day work. So in terms of that, there might be some things we look at Fibonacci ratio slightly differently, or some ways we look at other different things. But a lot of stuff is probably going to be familiar to most of you here. And so I kind of make no apology for that, because this is what we do on a day-to-day basis. But what I try and do is show you how we apply these in our day-to-day work and how we practically apply them to come up with positions and trade ideas and forecasts. So for me, the two great strengths of technical analysis, why do we use technical analysis, is pretty much, first of all, because we're simply trying to trend follow. And once a trend is in motion, we can obviously use a variety of quite simple or quite complicated techniques to follow that trend. But then the other key area for me of technical analysis is risk control, is identifying those resistance support clusters. And really, you can argue a lot of technical analysis is really about risk control. And I remember we've done quite a lot of teaching over the years at Credit Suisse, and we teach for clients globally. And I remember teaching a long time ago to a group of people, and a guy came along to the talk, and he clearly didn't want to be there. He was a fundamental guy. He really clearly did not want to be at this technical analysis talk. And we were chatting away, and he was very good. He was very sort of quite bantery, and he was quite jokey back and forth and stuff. And so we enjoyed the tutorial session. It was quite good to get that feedback and stuff. But he said, "Why do I need to do this? I make good money. Why do I need to come on this course? I've been sent here by my boss." And anyway, we did the course, and I met up with him about a year or two later. And then just in discussion with him, and I sort of said, do you use technical analysis? And he goes, you know what? Technical analysis does not make me any more money today than it made me a year, 2 years ago. And you know when you go, okay. But, then he said, it's lost me a hell of a lot less money. And that, I think, was one of the crucial things, one of the key things about technicals for me. It's this risk control, identifying our risk points. For us, I think it's the difference. What we're trying to do is mix mathematical and psychological techniques together. Technical analysis, the basis of all, is psychology. In our view, trends do exist, and trends, and certainly a major trend, can only exist if the fundamentals are there in place to support it. So we're not anti-fundamentals, we're not arguing against the fundamentals. In fact, we collaborate and work very closely with our fundamental colleagues. And a lot of the stuff we've done over the years and really benefited from is taking a look at the markets through their lens as well as our lens. But once we get trends going in different asset classes, the key thing for us is they clearly share similar characteristics. A trend in Eurodollar is the same as a trend, very similar to a trend in tenuous yields, is very similar to a trend in the S&P or gold. Trending markets share very similar characteristics. And really the basis then for this is psychology, is getting into the behavioral biases that we have and we apply when we look at markets. I won't really talk much about this just because there's going to be much more proficient speakers than me talking about this tomorrow, which is a large part of it. But things like risk aversion and loss aversion, gambler's fallacy, all these things, and again on the panel session this afternoon, I suspect some of these will come up when we're talking about risk, really are all about how it is not, in our view, an efficient market, or the efficient market is not complete. And again, this is a very simple slide. I'd love to take credit for it, but it's not my slide, but a slide we use. Just the classic psychological sort of cycle of a bull-bear cycle, describing the different states in that cycle, from being the most pessimistic down this side, where worse is, the news is absolutely its worst, and typically when the low is in place, to the most bullish at the top. And interestingly, I've been in a very fortunate position for what I do as a job that I get to go out and see a lot of different clients, and clients can be from a range of institutions, from execution desks to fund managers, to hedge fund portfolio managers, to CIOs, to central banks, and we see a whole range of people. So we see this different psychology of the market participants all the time. I think it was interesting chatting earlier on this morning that an American friend, Craig, has been out around Europe for the last 2 weeks and seeing all the investor base in Europe extremely pessimistic about European stocks. And we're not seeing this dynamic at this moment in time about the market at new highs in the S&P or near to new highs, and everyone being overly bullish, but people are not at that point in time. So trying to gauge psychology for us is crucial. And then psychology really comes into pattern analysis. I'm not going to spend this session talking about this is a head and shoulders top, this is a double top, this is a triangle. Clearly, hopefully we're all aware of what the different patterns are, but what I want to sort of talk about is how we use them in practice in combination with other things. What I would say very much about pattern analysis is it really different patterns reflect different stages of bullish and bearish psychology. So a head and shoulders top is a repetition of a specific state of human psychology. These patterns that exist throughout nature and through the markets as well. This is why we look at them time and time again, because they exist and repeat. And human psychology, for our benefit, does not tend to change over time. And the one thing I would say, and this is where I get into slight sort of difficulties with some systems and the ways of looking at markets, is I'm not someone that tries to overlay all the time my roadmap on the market. I have a structure, I have an idea of where I think the market is most likely going, but one of the most common mistakes I see is people trying to say, this can't be right because this doesn't fit into my view of the market. I don't think you can forecast in advance, we're going to make a head and shoulders top, we're going to make a double top, we're going to make such a type of pattern in advance. Indeed, when we talk about corrections, retracements, etc., we can have an idea where we think a market is more likely to go or more likely to find support, but forecasting it in advance is a very different thing altogether. And indeed, as we talked about before, or I mentioned before, actually putting the trade on to actually getting a successful trade is a very different thing. The position management is absolutely crucial. This, in a sense, ignore the slide to an extent, but what we're basically saying here with this slide is this is exactly the same system for a trading system for entering into market, but just changing our stock methodology throughout that system, which dramatically changes the P&L of the system. So once we're getting a trade on, the position management then is as crucial to its success as everything else. And the other thing as well is, again, why we're coming into, again, what we talk about in terms of how we use ratios and retracements and patterns, is also the fact of it's not the number of successful trades that we put on makes it successful. It's the magnitude of the successful trades that we actually do have, rather than the actual number of trades. So again, that is something that is pivotal to what we do, and what I think technical analysis can give us more than any other discipline, identifying those risk-reward scenarios that are most in our favor, that come about by ratio analysis, by pattern analysis, etc. So what do we do in practice? Before I talk about Fibonacci, which I will spend some time just talking through, I kind of wanted to run very quickly in sense of just on a sort of top level way how we sort of look at the world, what we do in our way of sort of analysing markets. We are quite a small team at Credit Suisse, there's 3 of us, but we sit across all the different asset markets. So we're multi-asset. We look at equity markets, commodities, fixed income, and foreign exchange. And I think that for anybody who sits in one specific market area, I think you should do this even if you are just specifically an FX analyst, because having that multi-asset view on the world, I think, is absolutely crucial. Because a lot of what we do is linked together from that intermarket, that multi-asset view of the world. So we have, first of all, we always set a discipline framework for what we do. And I think discipline and having that framework is absolutely crucial. So there's no one indicator, there's no one specific technique. We're applying a whole range of techniques. We happen to look at some of the classic stuff like trends, moving averages, trend lines, envelopes, etc., pattern analysis, ratios, resistance and support, which is Fibos, which is all in there, momentum, exhaustion, volume, volatility comes into how we look at market breadth, and so on. But we also look at a cross-asset work, and we also have a range of bespoke different indicators, the risk appetite series of indicators, which any of you, if you have seen me speak before, I've talked about, and I'll have a couple of slides on here, but I won't go into their details. So first of all, the first thing we do before we even start to look at the pattern of the market, the ratios of the market, the retracements, etc., is what is the market state that we're in. And so we have a range of different risk appetite indicators that we've worked with our actual strategy team over the years. This is just, I won't go through the mechanics of this. If you did want to know about it, please ask me afterwards. But this is our classic risk appetite indicator. And essentially what we have by this is moving up it means risk on. Essentially moving down is risk off. In a sense, that's not quite true, because what it's actually saying is in a move up, risky assets should outperform. In a move down, safe assets should outperform. That can outperform in an uptrend or a downtrend. So we set the broader framework, risk on or risk off, safe assets or risky assets. We then look into a general question, should we be in equities or bonds? How does the equity-bond ratio look? This is a G5 equity-bond ratio. We'll look at a US, a UK, a Japanese, etc. But just generally, should this be in an equity or bond environment? We will then move on to say, okay, within the equity environment, should we be in safe equities? Should we be in risky equities? Should we be in emerging markets? Should we be in developed? And what we're trying to set in this sort of initial big picture top-down framework is, what is the core direction? Is it bonds? Is it equities? Is it risky equities? Is it safe equities? Is it risky bonds? Is it safe bonds? And when we get to that, we then look at, well, how do other things look? How do credit markets look? How do funding markets look? What is the general state of the broader world? And we put these things together and then hopefully leave us in a situation, this is a pro-bond environment. This is a pro-equity environment. And then that should structure in terms of then the underlying themes that we're playing. So then we look at bonds. We have our fixed income risk appetite model. Now again, I'll skip through this. And then we look at things like inflation. And I just had to put this chart in it here today because this was fascinating to me in terms of looking at trends in markets compared to what economists are looking at, compared to what central bankers are looking at. But this is specifically Mario Draghi, the head of the central bank, ECB, had basically said back at Jackson Hole conference in August that for European inflation was their big concern, and they were targeting five-year euro break-evens, which is quite an obscure sort of area of inflation to focus on for some reason, quite a small market. And in fact, probably the main traders in this market are the French. And he talked about this in August, when probably most of France is on holiday. So it was quite an interesting decision by Mario Draghi, who's clearly a very interesting person, to focus on five-year European break-evens. But he focused on this as his measure of inflation. And so we can keep a measure on this. And he focused on it just at this moment in time. So if just as we came down to the bottom end of the range, did he actually talk about European break-even inflations, which then held for a brief period of time. But I'm digressing away from the core topic of what we're trying to talk about today. And the first of that, really, what I want to talk about is ratios and is Fibonacci. But before we even get into Fibonacci, we have to really, for me, talk about what Fibonacci or ratios are. They are another method of potential support and resistance. And we look for support and resistance from a variety of different sources. It's not just Fibonacci that gives us support and resistance. We've got resistance and support from old highs. We've got support from old lows. We've got trend support. We've got moving averages. We've got Fibonacci levels, which we'll talk about shortly. But we've got pivots, we've got gaps and patterns and many, many, many more. And the key thing I want to take away really from my talk today is the most important resistance to support areas, the most important things for us are when we see clusters together. It's clustering of levels is the most important thing that I focus on in our job. The more reasons we have for a level to be a level, the more likely it is the market is going to stop there, the more we can structure things in our favor and put the odds in our favor. And if this clusters then tie in with patterns, and if those patterns tie in with the broader risk-on, risk-off sort of direction of the market, be it a pro-bond, be it a pro-equity, then we're really trying to stack it all in our favor as much as we possibly can do. And this is all then about getting that entry point into that trade. So I was slightly nervous when Marcus was speaking that he was going to go on in a huge sort of depth about Fibonacci, and which is going to make it quite difficult because one, seriously, talking mathematics against a professor of mathematics from Oxford, and sort of me talking mathematics is always going to be a road to ruin from my side. But I have kept a few little charts on Fibonacci, and because I think it is important to look at the background where it's from, just to really add a little bit more color from what Marcus said. Clearly, Fibonacci has been around a long time, well before Leonardo Fibonacci himself. It's been around for generations and generations and generations. But really in the West, it was really this first book where it really started to come into sort of focus again, and this problem, this very famous problem about the pair of rabbits. And as Marcus said, the Fibonacci series comes out of the growth series. It's this growth pattern that appears throughout nature. And it's this growth, expansion, and indeed maybe contraction as well, that defines the Fibonacci series and why it's so important and why it appears throughout nature. And if it appears throughout nature, then why shouldn't it appear in the financial markets as well? Especially when financial markets are essentially the human interaction of crowds at their most largest, in our view. So we've clearly got a lot of fascinating mathematical properties, and I've kept this slide in essentially because I want to bring attention to where we get some of our core Fibonacci ratios and projections that we use on a day-to-day basis. So as was talked about earlier, we've got obviously the golden ratio, the golden mean, and phi that comes out of our series. So we get, obviously, dividing each number by its next high number tends to 0.618 as we tend to infinity, and dividing each number by its next lower number tends to 1.618 as we get to infinity. And this 1.618, the golden ratio clearly has some very, very fascinating properties. Just a few of them are here. And I think the key ones for us, clearly, we've got these fascinating ones here, multiplied by itself, gives us 1, etc. But 1 over phi, 1 over phi squared, 1 over phi cubed gives us the core Fibonacci ratios that we look at and use today. So if you wanted to know where those core ratios come from when we apply those retracement levels on our charts, this is essentially where they come from out of the actual series themselves. And essentially we have this link between addition and multiplication coming out of Fibonacci series. And then we get into the mathematics, we get into where this appears throughout nature. We have lots and lots of different examples of this. We have the golden section of a line, which was solved by the Greek mathematician Euclid, and we can see that there. But why this is important in terms of this ratio, where basically we're dividing x by c and a, and then c and a by b and c, where that moves is in the Fibonacci ratio. Where that's important is then that starts to come to construct this thing called the golden rectangle. And then the golden rectangle itself is where we start to get into the phi spiral. And it's this phi spiral, this growth spiral that comes through shells, through galaxies, through pine cones, as Mark was saying, or flowers. This whole growth cycle that appears throughout nature, and is really the Fibonacci sequence, the Fibonacci ratios are all part of defining that. And so if we can see this throughout nature, it originally was implied, well, why can't we then use this in the financial markets? To define the growth and expansion of financial markets, to define the growth and expansion of various different swings in a stock market originally to start with, and probably Ralph Elliott that first started to look at this when he was looking at the stock market, and he was looking at the ratios of different swings within the stock market. But now it's applied throughout the financial markets, and it's essentially trying to tie in the relationships between different swings in the market. And I think what I would say is, getting back to sort of the very original things, there are great periods of time where we clearly have ratios that work very well, and there are periods of time when the ratios don't work very well. And so tying everything down to one specific ratio, a 38.2, a 50, a 61.8, it's clearly not going to work in our favor. We want to overlay and rank as many ratios, as many projections, with as many other sources of potential resistance and support as possible, looking for those clusters. And I think it's interesting if you look at some of Connie Brown's work, and I don't know if Connie's here today, how she's taken this more forward as well, looking at more at this growth and expansion and how you move the Fibonacci ratios as you actually grow within the cycle swing of an uptrend in a market. So just looking at then the ratios themselves and just some of the very basics, I mean, hopefully most people here are familiar with how to apply Fibonacci ratios, but all we're simply doing, for those of you who haven't, is when we've seen an actual rally in a market from a point A to a point B, we're dividing that vertical distance, multiplying it by the ratios, and looking for those to act as support or resistance if we're in a downtrend. And the important thing is, it's just a potential support. It is a potential support. Everything is a potential support. Nothing is set. It's all we're trying to stack it as much in our favor. So we divide every rally, once we've seen a peak, into the 38.2, 50, and 61.8. Very straightforward, simple definition of Fibonacci ratios that probably most of us use today. Interestingly, when we sort of knew Marcus was going to be sort of talking and knowing and sort of having read some of his work and looking at primes, we started to do some research into primes, just to see whether there would be anything interesting that we could use on primes. And I have to admit, we did hit quite a few brick walls. I think we had some of the interesting bit was on the prime gaps, if I'm not mistaken, where we had sort of the difference between the prime numbers as we move up. And I think it's right that 2, 4, 6 are certainly the more common ones, as we're at shorter term, sort of lower numbers, not so much when we get to the higher numbers. So the only kind of real ratios or numbers that we really kind of took out of it from some, I have to admit, very tentative dabbling on primes was the 2, 4, 6 ratio, which clearly we can take out of that 1/3, 1/2, and 2/3. So it would be interesting just to see, the combination of maybe applying the 1/3 with the 38.2, which initially people did a lot as well. But we didn't really come out with specific sort of information that helped us by looking at prime numbers or prime ratios. But it would be interesting to see whether primes are there in terms of specific numbers to unlock other things. We then also use Fibonacci projections. Again, very common sort of technique that probably most of you use. What we're doing here is once we've seen our vertical move or our move rally from A to B and we've begun a correction, with a Fibonacci projection, we need our 3 points. And in the very straightforward, simple application of projections, all we're doing then is taking that vertical distance and applying the ratio, Fibonacci ratios, from that vertical distance onto that point C, 0.618, 1, and 1.618, and applying them in the future. So what we've got is the Fibonacci ratios, retracement levels, looking at the contraction part of the market as the market begins its correction, and the Fibonacci projection ratios, looking at the expansion part of the market. And so by combining the two, and I think that is also what we do, we try to capture and look for the swings both back and upwards in the market, looking for basically the Fibonacci retracements to try and give us an idea of the contraction, and the projections then to give an idea of growth as we move forward. And then what we do is then apply those on top of each other over different time frames with other techniques to try and give us some idea of the strongest support zones and the strongest resistance zones. So it is very simplest. Just a few examples. The 10-year German yield, simple move down, A to B. We begin a correction. We break our 40-day average. We begin a correction. Straightforward, first retracement level is a potential support for that market. This is a yield. So we talk about, for people who don't do fixed income, we talk yields and support and resistance slightly the other way around. We can use this in a variety of ways. We're obviously just showing one level on its own here, but we use retracements and projections in lots of different ways. It could be a target for correction, an entry point into a new trend. It could be a take profit, signal on an actual a trade in that direction. But it's used in a combination of ways. But what is important is it's just another form of resistance, in this case, or support. We use them over every time frame. So this is a 10-year Treasury note on an hourly basis, a very much more short-term time frame. We can see here the decline AB, the straightforward Fibonacci, 38.2, 50, and 61.8. But here's where we start to see the first things that we start to add on top. At this point in time here, the first ratio retracement, 38.2, isn't just a ratio on its own. We tie in with the high that we've just seen. We had our first high where we tested the move there, but also we tested in with this price gap. And so we suddenly start to think, well, we have more than one reason why there should be resistance, more than one reason why we should be looking for the market to stop there. And that is then the beginnings of what we're looking to try and do. We're not just applying ratios, retracements on their own. we're applying multiple ratios and retracements on top of each other. And we're looking for these areas where we get clusters together, because at that point, we get the strongest potential support or resistance, or the potential strongest support or resistance, and we're stacking things more in our favor. And indeed, I think the interesting work for those of you who have seen Connie Brown's work is she puts great emphasis on these price gaps, and she will actually alter her Fibonacci ratios around these price gaps and putting a 50% retracement in that gap. And I think that is a very interesting area of work. She does that, and forgive me for maybe misquoting her, to try and really account for that growth and expansion as we go through. We try and account for the growth and expansion by combining ratios and projections in both the up moves and the down moves. But the key then is this layering of retracements. We're not just putting one level on. We're applying levels over retracements over lots of different time frames. So this is the 5-year US Treasury yield, the big decline we've seen. We've started our basing process. We have our first move up. We have our correction. We would put our retracement levels on there. But after we started our second move, again, we're looking for the retracements, the Fibonacci retracements, to try and define where the contraction points are within the swing of what is potentially now a new upward trend in the market. So we're applying not just the retracement levels from the low to this high, but also the low to this high. And this is where we see these clusters of levels coming in. And this is what we're trying to identify all the time. In practice, if we have on, we will then go down to a short-term chart. This is a weekly chart. We will go down to a daily chart. We will go down to a 5-minute chart if needs be, and look for even the more further swings that exist between that. And what we're trying to do is identify as much as we can clusters of levels. Initially from the Fibonacci levels on their own, and then we bring in things like, well, do we have old highs? Do we have potential trend lines? I've obviously drawn no trend lines on here. I've drawn no moving averages on here. All I'm trying to highlight on this chart at the moment is overlaying of retracement levels. In practice, nothing is used in isolation. We're actually, in practice, overlaying lots of other methodologies on top, looking for as many reasons as possible why that should be a support level, why there should be an entry point into that trend. If I have 10 potential indicators, 10 potential technical things I'm looking for on that chart, and I have 5 of them in my favor and 3 of them neutral and 2 of them against, well, that's not giving me the great odds. But if I can get 8 of them in my favor to say this should be a major support, it gives me greater confidence to enter my trade at this point, ideally now in the direction of what is the new trend with an excellent risk reward. So we're trying to build up from that point. And again, then we apply this on an intraday basis. So again, if you go back, again, this is euro-dollar, this case on an hourly chart. We have our move down, A to B. We have a move down, C to B. We have, in fact, this move down, D to B as well. What we're doing is applying our retracement levels on all of the swings down. We'd apply it from that one, from this one, to this move down to B here, looking for potential clusters of levels together. In euro-dollar, we can see at this point in time here, we have our 2 retracement levels overlapping together again with this high. And this is important as well when we come to this money management, performance management side of what we do. Because intuitively you may say, well, this is a short position. We've been trending downwards on euro-dollar. Maybe this was a top. Maybe this has triggered us into a short position. Where should that short be? Should it be the stop be above the point C? Should we lower it to above this point here? But being aware of where the clusters of levels are, we can see in this chart is having a stop above here, these little highs in there, was not the sensible thing to do. We have a lot of resistance levels clustering just above there. So it helps us to pinpoint more specifically where the stop should be and where the performance management system should come in. And this, to me, is, I say, the great use of Fibonacci retracements and projections, because it helps refine the stops, it helps refine the entry points, it helps refine the risk points to a much greater degree. And when we do our work, and if you ask my team, I probably drive them nuts on it, I'm anal about the specific levels, about where people identify support and resistance. Projections, again, this time we're looking at expansion or growth in a market. So we use projections to give us an idea of the different swings ahead of time. So we're clearly forecasting in advance on a trending market. So this, again, hopefully for most of you have seen Fibonacci projections and how we apply this. So we have an initial move beginning at the end of this downtrend, this initial basing pattern, ABC. We would apply our first projection levels to this ABC move. We have our initial move, A, B, and C. We're looking to apply, I'll be careful this time, this vertical move that we've done, applied from that low to give us our first initial target if we're genuinely in a new upward trending market. where the first target, where the first objective should be in that new upward trend. And we can see here the red line is 0.6, the green line is 1, and then we have our 1.618. And in fact, that actually ties in fairly nicely with an old high, so it gives us a first potential target. But then what we're doing is continually doing this as the trend develops. So we'll be doing it on this next move. We'll be doing it on this next move. We'll be doing it on the swings in between. And we're doing it on every move. We're not looking for levels in isolation. In fact, the levels we get on their own are the ones that are just not interesting. We're looking for where we get the clusters of levels. So if we move forward on Aussie dollar again, same chart, same market, we now have ABC, the next move. These are the ratios. Again, we again stop at this move. We'll then move forward. And again, we have our next move, the ABC. And again, actually at this point in time, we stop here. We then stop again. We then stop again. And the more times we stop at a level, and especially when we get the cluster of levels, the potentially more significant then that resistance or support will become. In practice, then what we do, and I've showed you in a sense the very straightforward, simple sort of first retracements and projections, we apply a whole range of projections and a whole range of retracement levels. And then we apply that, and we have a little spreadsheet. I have a little spreadsheet that I chuck these things into. I pull them out. And so from this, then suddenly getting 1, 2, 3 levels or 4, 5, 6 levels, what I'm trying to identify then is those clusters of levels that come together. Do I have an area where I get 4, 5, 6 retracements or projection levels coinciding? Even more. And so I'm trying to isolate the levels where they cluster together, because the more reasons there are for a level to be a level, the more likely it is that the market will do something off it, or the more stronger the likelihood is that we can construct a trade strategy around it on a risk-reward basis, putting in our stops above or below. And so then if we look at just a straightforward example, clustering together of levels, this is just on crude oil. We again do the swings of the moves up, the moves up, the moves up. At this point in time at the high, we have 3 different projection levels. These are just projection levels, all coinciding together. If I can identify those areas in advance, it hopefully gives me a clue. These are the more stronger areas of support. These are the more stronger areas of resistance. These are the areas where, if I'm long, should I be taking profit? Should I be putting my stop up? Should I be potentially getting out of my position? Should I be trying a short? And then what we do in practice is then overlay a whole range of techniques. So this was, again, going back a little way in this market. This was the S&P at the bottom of the 2000 to 2002 bear market. I've kept it in just because it kind of is a nice, and I will look at some current sort of illustrations shortly in terms of current markets, but this was quite a nice example where we have things clustering together. This was clearly the bear market, the base pattern that completed in the S&P 500. Once we started this bull move in the S&P after we completed this base, and we definitively identified the trend in this pattern, telling us that the trend had put in a base and turned from down to up, we can then start to look, well, what are the retracement levels of the move down? What are our pattern targets? Where are our old resistance levels? Where are our Fibonacci projection levels? And we can see here, just looking forward from this point in time when we establish this base, we have a base target at 1130 in here. We have a 50% retracement at 1160. We have a 38.2 retracement, quite a lot lower. We have a key projection target up at the 1160 level as well. We have these old highs at 1173, 1177. So what we're then trying to identify is where are those big clusters of levels together. And then when we get to those clusters of levels, we can then start to apply things like momentum, exhaustion indicators, volume, breadth, and to try and determine how likely then is the market going to stop at that point in time. So in a sense, there's nothing unique, there's nothing sort of rocket science sort of about this, sort of what we're trying to do. I'm sure it's an approach that many people do today. But the key thing we're trying to do is layer these different techniques on top of each other, looking for these opportunities where things cluster together as much as possible and focusing on those as levels. This then doesn't get away from the other big fact of what we're trying to do as much as possible is identify trends as well, and run trends. And the biggest challenge I sort of often find is at what point do we say we exit out of a trend, and what point do we continue to run a trend? Because I think some of the most profitable trades that we can do are when we put a position on in the first place, the market starts trending aggressively. And when we put a position on in the first place, when we have a target from a pattern or etc., we think, well, this is my take profit. And in a lot of cases, my take profit level. In a lot of cases, that is the right thing to do, to take profit at that level. But clearly, we want to have a mechanism that can help us run the big trends. And so switching the system from that take profit, that retracement, that resistance zones, to a running of the trend is one of the key skills to get. And that is, you know, a difficult thing to try and do to make that call, when to run and when not to run the trend. So I want to just a quick look now at some examples, and then of how we have applied these in practice, and how we sort of use these sort of this day, and some of the examples hopefully from this year and the current examples that we're focusing on, and how we've used the practical application of patterns combined with ratios, combined with other techniques, to really put trades on, run trades, and essentially establish core views in the market. So the first thing, so we look across a whole range of markets. The first thing we're trying to do, once we've established what is the broader risk environment, risk on or risk off, pro bonds, pro equities, is then get into what are the core trends within those markets themselves. And if we're looking at FX, which we cover the foreign exchange markets, one of the things we're always doing is looking at the trade-weighted indices for all of the major FX currencies. So instead of just looking at the euro dollar, euro against the yen, euro against sterling, euro against the Swiss franc, we would start off and look at what does the euro trade-weighted index look like? What does the dollar yen, the yen trade-weighted index look like? And do we have any significant structures there? It's because if we have those significant structures in place, they can then give us that lead-in to where we should start to establish a core position in a core currency. What we had at the end of last year, this was the Canadian dollar trade-weighted index, is a classic pattern, a classic long-term top that are developed in the Canadian trade-weighted index. The support levels, this is a weekly chart, so they actually, you're not getting the actual lows that we saw during the week at that time. The support levels pretty closely then overlaid with the first retracement, the first Fibonacci retracement of the entire of the previous bull market from back in 2008. And so when we break down at this point in time here, this initial starting point was there is a significant top for the Canadian dollar. So our whole structure for the Canadian dollar should be looking to be, we should be getting short. Well, the question there is, okay, what do we get short against? There's a variety of potentials for that. So then we get into the different currencies against the Canadian dollar. And at this point in time, we then had the dollar itself against the Canadian dollar was the most interesting, probably out of the crosses, this and sterling against the Canadian dollar. And when we've already had this framework, there's a significant top in the Canadian trade-weighted index, we now look to the fact that we have a significant base in dollar Canada itself. And then at this point in time here, which is essentially when we topped back on the trade-weighted index, back at the end of 2013, we then essentially establishing a significant base for dollar CAD. So then we need to look at, okay, we have a significant base in place. Where are our clusters of retracements? Where are our clusters of supports? Where are our clusters of resistance levels? How do we determine, first of all, where we think this bull trend is going to extend to? There is a potential variety of sources for that. The classic variety, first of all, was what is the straight target from this pattern, if this is indeed a base, which actually is highlighting above the 119 level. But what we identified fairly quickly is by putting our retracement levels on, we have a cluster of levels back at the old top from back in 2009. We have an old topping process. We have a 61.8 retracement. But also on this first swing of the move here, by applying our Fibonacci projection up here, we also have the first major projection level coming in at this point in time here. So the first starting point when we saw dollar CAD break out of this base is this is a significant bullish pattern, and this is our template for where the market should extend to, or the most likely area where the rally should extend to. It's not telling us this will be the top, this is exactly where it would go to, but it's giving us framework of where we think a market may likely extend to. Once we've actually got this position on, it then very much becomes a money management position, a position management position, because as we've talked about, patterns can change. We can go from a non-pattern to a pattern state, and likewise from a pattern state to a non-pattern state. We can go from a trending market to a non-trending market, and we have to be disciplined about then where we establish our stops, where we run our position to, and be able to say, actually, this is where we exit out of position, not at our target, but ahead of our target, or we run beyond our target. But the initial starting point is we have our recommendation for a move up to this level. We then move forward in time, and interestingly, if you actually do then move forward, you see the initial rally in dollar CAD actually then went pretty much exactly into the first 50% retracement of the whole of this bear trend. Went slightly above it, but that was for literally one day, and then we retraced. And then the retracement phase is the interesting phase, because this is really the area I wanted to focus on, because this is there when we get into where our Fibonacci comes into its own, identifying these strong potential clusters of levels where we may look for support, which is going to give us an idea of our stops, where it's going to give us an idea of potential additional entry point into a trend. We apply the retracement levels across all the swings we've seen. So we apply, once we believe we've seen a top, we apply retracement levels of that move. We would apply retracement levels of this move, but also of all the additional swings within there from that original grid. And what we're looking for is the clusters of levels to come together. And so what we found then, quite quickly, is the top of the base, which is also resistance, ties in with the old highs in here, ties in with the uptrend line pretty perfectly on dollar CAD, ties in with the first retracement of this move, ties in with another retracement of that move. And so identifying in advance, there is likely to be a potential strong area of support ahead of time. We could identify this ahead of time. This is a very potential strong area of support. It doesn't say we're going to go to that area of support, but it gives us a very strong idea where our stops should be in that trend. We would then come down to a more short-term basis, and this is a daily chart of dollar CAD, and this is where we kind of work in what Connie Brown does in terms of the growth and expansion and contraction side, is we then, besides just having our retracement levels of all the move on the way up, we then look at the actual projection levels of the move on the way down, looking for the actual expansion of the actual correction when we see it. And what we find out straight away is just on this first projection of the first move down, this ties into the 106.31 level, which again is tying in at this major support zone. So we by essentially looking at all the different swings we've got in the market, applying all the different sort of retracement levels on top of those, looking at the different resistance and support levels, filtering them together to then identify what is the key area and what level should we abandon and what the cluster is, can then give us that clue, this is where we should be looking for support. And then, at that point, we're then applying trend lines, uptrends, moving averages. We're applying moving average envelopes. We're applying DeMark, exhaustion. We're applying momentum, which then starts to filter in on top. When we had this decline, this is going back again to the daily chart, at the low on the 3rd of July 2014, which is at this point in time here, we had a DeMark combo 13 exhaustion signal. We also then had a MACD buy signal 3 or 4 days later. What we're trying to do is stack as many things in our favor as possible to say this is the support, this is where we should structure our position off. We're not using retracement levels as one on their own to try and define the whole market. Everything is a support potentially, a resistance potentially, and the more we can stack in our favor on that, the better. Another sort of good example has been the Japan over the last 1 or 2 years, and I want to quickly just talk about just the Japan example. This is, first of all, again in FX, we start off with the trade-weighted index. So this is the yen trade-weighted index, and we can see here this sort of classic double top, straightforward, simple pattern double top in the yen trade-weighted index, suggesting that there may be an important reversal going on in the yen. Clearly, we've had a big basing structure. The target from that basing structure has been achieved. But once we start to apply our ratios on this move as well, the first ratio of the whole move up, 23.6. The ratio off here, 38.2. The ratio off here, 61.8. This low was not only a key low that would define a pattern break, but we straight away had 3 different retracement levels coinciding at that point in time. It at least tells us or gives us an idea, if this level is to break, this is potentially not just a minor change that's going on, but there's potentially something more significant that's changing trend here. And so when we did see that break, that suggested to us that that core uptrend in the yen had changed from up to down. We would then go through to the different yen crosses. We had dollar yen, we had euro yen, both completing bases at the same time. But we also looked then, and this is the other important thing about patterns, is patterns are not just taken in isolation. A pattern in one market can have a direct link on into a pattern in another market. So we're suddenly starting to look at intermarket work. And suddenly we're looking at, well, actually, especially in Japan, the relationship between the yen and the stock market is extremely strong. This is just the yen trade weight index overlaid with the topics, which is actually inverted, so it's an inverse relationship. But we can see here how strongly they're related. So if we have this significant reversal going on in the yen, we have this whole cluster of retracement and ratio levels that are broken, warning that the trend had convincingly turned, then what should happen in the stock market? How does the stock market look? And then we can look at the stock market. We look at not just the Nikkei, where we have this major then suddenly base and breakout at the same time. But then we can look at into the sector level, because if the stock market's going to look good, well, how do the sectors look? And then we can take it even further and go, well, actually, the yen overlays, or has great long periods of overlaying extremely well with 10-year US yields. So how does then the extrapolation then move on to the fixed income market? So everything is interrelated. And hopefully, I'm probably being way too long-winded about talking. We're talking about applying Fibonacci ratios in practice. In practice, we're not just looking at here's an AB move and here's our 3850, 61.8. We're trying to build up a much more bigger picture than that and trying to overlay a lot more things together. And then we're trying to take that and then move that out, not just from the market that we see that in, but then into interrelated markets. I'm going to run out of time. I can see my time is counting down. But the one thing I'm very quickly going to end on, I think this has been a fascinating year for technicals and fundamentals, especially in the US fixed income market or in the bond market in general. So for anybody fundamentally minded, we've had this very sort of strong set of economic data that's come through from the US all year, and a fundamental analysts and the vast majority of the fundamental community have arguing for yields to rise through this year. But it's just interesting to show how important it is that we focus on the trend and not, we just focus on the how and not the why of where a market moves, which is what we do as a job. Our job is to focus on the how and not the why. At the end of last year, this is our risk appetite model. We had this model coming in, and I'm very happy to talk about this with anybody afterwards, essentially saying at the end of 2013, our risk appetite model was in panic. It gave a buy signal. This was a signal that yields are more likely to rise. Sorry, yields are more likely, excuse me, yields are more likely to fall from here. Risk appetite is more likely to rise coming into the end of 2013. Just whenever the fundamental community was talking about yields are going to fall, just as the fundamental community were talking about yields were going to rise through this year. And then we tie that in with straightforward technical analysis. Let's look at the long-term chart of the 30 US yield. That signal in risk appetite came in just as we saw the 30 US bond yield move up to the top end of its multi-year trend at the end of last year, the beginning of this year. So getting extremely bearish US bonds at the end of last year and into 2014, just when you're at the top end of its multi-year trend, was, as a technical analyst, clearly the wrong thing to do. So then when we've taken our very big picture basis down, the missed risk appetite, the long-term trends, let's focus on the shorter-term trend. This was 10 US yields. This is the move up we'd seen into the end of the year, into the retracement level at 61.8, just ahead of this little top structure, which I have to admit we thought there was a chance we could meet that. And then we started to turn down after the second attempt here, which is also at the top end of this trend channel, just as we had these other signals. But then I think the most interesting thing through this year is we had this environment, the yields declined for the first quarter, but then another measure of fixed income in the US, and this is the 5-year US forward, which is, again, another measure of the 10-year. We saw very simple, very straightforward, double top pattern complete in April of this year, telling you that yields were going to fall a lot further. So having all these factors up, it's trying to keep us cold and neutral to all the fundamentals that are going on around us, all the data, and it's telling you focus on the trend of the market, and let the trend tell you it's changed, not the underlying data. And I've circled these points in here because this was really interesting point. This was all the non-farm payroll release dates that we've seen through this year as 5-year yields continue to decline. And all these extremely bullish numbers for the market at no point made an impact on the direction of the trend. So it stresses to me, and I'm slightly diversing away from retracements and ratios and patterns, but just the importance of technicals, keeping you cold, neutral, focus on how a market's moving, not why a market's moving, and let the market tell us when it's changed its direction, not the underlying data itself, because that can stay completely different for long periods of time. I can see the clock is about to go against me, so on that note, I'll stop there. Thank you very much.